Happy Chinese New Year. Apologies for all the tech disruptions. And also, I just recovered from a sore throat, so I have to apologize in advance in case you hear my voice like a bit coarse and all that. Okay, after the Chinese New Year celebration, so having sore throat. Okay, so I think I'm pretty new to the OTCS community lah. So maybe I just share a bit about myself. So I've written for many different websites like Fu.sg, which is now smartinvestor.com.sg, Dollars and Cents, Yahoo Finance Investor One, and all that. So I am also ACLP certified. That means I can teach skills future courses as well as a SGX Academy speaker. I also founded this Small Cap Asia website, and then recently I came out with this new YouTube channel. All right, so this YouTube channel will be more covering on both Singapore as well as US stocks. So right now it's just started for a few months. I think right now it's 300 subscribers. So appreciate if you can help me to achieve my goal of 1,000 subscribers at this bit.ly/investcard link. Okay, so once I hit the 1K subscribers, then I'll be more confident, and then maybe I'll make it more frequent and things like that. Okay, so without further ado, today's agenda, okay, we'll talk about macroeconomy. So I'm talking about US stocks and economy today. All right, I will talk about the market sectors as well as give you 3 US case studies. Okay, so the first one will be the macroeconomy. So what we have now, right? Every time you look at the news, the US news is all layoffs. Google laying off, Netflix laying off, Amazon laying off. And you can see from the chart over here, okay, since January 2022, okay, the employees laid off and the companies with layoffs have been increasing sharply to the recent January 2023. So the trend has been growing, okay? And sorry for the format because by right this one is supposed to be going onto the Google Slides. All right, so there's an acceleration of layoffs since January 2022. Okay, and if you were to check out this website called layoffs.fyi, okay, they focus the layoffs on all the tech companies, Google, Microsoft, Cisco, Uber, and all that. All right, and what we can derive from here is that most of the layoffs, right, are mostly in tech. So what happens is that over the 2-3 years, right, during the pandemic, all these tech companies, they wanted to gain market share, they wanted to compete with the other companies, so they decided to hire a lot of people. So they have over hiring, and right now is just trying to trim off this so-called additional layer that they feel that it's not productive. Okay, so you can see that it's mostly in tech companies. And what I read about, okay, this layoffs is that because of all these the technical people that they have, they all have a very good skill sets, and they are likely to find new jobs more quickly as compared to like blue collar and all that, because tech is definitely in demand. You go out of Cisco, maybe you can jump to another ST engineering, cybersecurity, something like that. All right, so it is not as bad as it sounds with all these layoffs, because it is happening in tech, and all these tech savvy engineers, software engineers, and all that are likely to find new jobs. So the second thing about the US economy is that high inflation has caused high interest rates. So the government wants to step in and control the high inflation. And you can see that the interest rate has gone up to 4.5%, and the Fed projects it to increase to 5.25% at the end of this year. So not so sharp increase from last year, but still, there's a bit more of high increases. The scary part is this is what everyone is talking about, this inverted yield curve. If you look at this picture, right, the normal yield curve, the blue color line, is going up, and then as the number of maturity of years, all right, the yield starts to come down. But in the inverted case, right, you can see that it's actually high at the start and then going down at the end. So what does this mean? All right, let me share with you the cause and effect of this yield curve inversion. What does it mean um, in layman terms? Okay, yield inversion is that, to put it simply, is the 10-year bond, all right, interest rates is actually lower than the 3-year interest rates. And this happens when investors are nervous about the future and expect short-term rates to fall. So if you think about it, common sense, right? You invest in something for 10 years, you want higher returns, right? But in fact, you are getting lower returns than the 3-year. Yeah, you are getting lower returns in the 10 years compared to the 3 years. So when this happens when so many investors think rates are going to fall, all right, the 3-year rates are going to fall. So they crop into the longer dated 10-year bonds to lock in the so-called high rate. And this makes it a yield inversion. Okay, and why is it so important, right? It's because of the effect that it has on a lot of people. Okay, so this guy, all right, is Harvey. Okay, he's the godfather of this inverted yield curve. Okay, he created this yield curve effect. And since World War II, he predicted that every yield curve inversion has been followed by a recession in the following 6 to 18 months. And recession is usually, stock market crash. All right. You can see from here, all right, how he has performed, okay, since 1965. Whenever there is a negative, that means the negative spread, they're going into the red color zone, all right, it is followed by the recession within the 1 to 2 years. So if I were to, okay, maybe take a pen. So let's say you look at this, all right, this is the recession. Okay, you look at this, the gray color is the recession. Okay, you look at this, 2009, right? And then this is the recession. So within 1 to 2 years, there will be a recession. Okay, but what is the contrary case here for this year itself? Okay, this is the quote from the Godfather, right, himself. Right, he mentioned that my yield curve indicator has gone code red and is 8 for 8 in forecasting recessions since 1968. However, he believes that it is flashing a false signal now. So what does it mean? Okay, so he explains it over here. So the first reason is that because of the popularity of this tool, this inverted yield curve, it impacts the behavior and induces the companies and the consumers to take risk mitigating actions, such as increasing savings and avoiding major investments, which bode well for the economy. So the second reason is that, is what I said previously, all the large job cuts are concentrated in the tech sector. So my take after hearing all this, right, is that, okay, while I feel that, okay, the recent recession will be averted, because when everyone is talking about recession, right, chances are, the recession won't come in. Okay, but it will be a long winter of slow growth, because when we think about it, we have high interest rates and it's like unlikely to come down anytime soon. They won't say that, oh, this year 4%, next year 5%, then maybe I'll go down to 0%. Very, very unlikely to happen. All right. So they are forecasting that the recession will come. Okay. And they are willing to do that to control the high inflation. So what I feel, okay, personally, is that there will be slow US growth, okay, and it will likely persist for at least 1 to 2 years time. So let's talk about the market sectors. All right, so I don't have a crystal ball to predict the whatever market sectors will do well. So I turn to this image over here, and this is a image of the market cycle. You have let me see, okay. So over here you have the market top, over here you have the market bottom, and all these are the sectors. Okay. So over here we can see that the late expansion part, right? Energy sectors is performing. So oil and gas stocks like Chevron, Occidental Petroleum, they are booming. All right. And then afterwards, you have consumer staples and utility stocks performing. So you think about it, consumer staples like maybe P&G, Colgate, Pepsi Cola. Okay, Pepsi Cola maybe not. Yeah, utilities. You think about it, Sembcorp Industries, Keppel Corp. You know, when they focus on the utilities, because of the sharp rise in the energy, okay, actually it benefit all the money go into them. All right. So this is, if you are saying that these two sectors are performing right, so we are already experiencing an early contraction. Okay, and when you think about it, okay, when you say banks, okay, financial banks like DBS, OCBC, right now they are going up, right? Bonds going up, right? Financials going up, right? So are we close to the market bottom? Okay. So this is something that you can analyze yourself, lah, right? So I just give you this image to I just share with you this image. Okay, but what is the three sectors that I will cover today for my three US case studies? Is the financials, consumer, cyclicals, what we call like maybe luxury goods, travel, cars and all that. All these are consumer cyclicals. It means usually, people will go travel, buy car, right? And then you have technology. So technology is weird that it's over here, but I will also share with you all in the case study. So now let us dive into the three US case studies. Okay, for the first stock is this Charles Schwab. All right, if you haven't heard of it before, it is based predominantly in the US. They have acquired, all right, TD Ameritrade in Singapore. I think 1 to 2 years ago. Okay, and their business model have evolved over the years. So in the past, they have been focusing a lot on maybe trading fees, and all that. But recently, they shifted to AUA. So I think similar to that of the iFast Corporation. So what they earn, right, is the net interest income based on the cash that's inside their customers' accounts. So let's say, for example, I put in 10,000, I only use 5,000 to trade. So the other 5,000, I park it with Charles Schwab, and they are going to earn the very minor 1% interest. But if you think about it, if you have trillions of dollars, billions of dollars, that 1-2% is very significant. Okay, and although this kind of stock brokerage or fintech companies is nothing special, their competitive advantage is that they are focused a lot on operational efficiency. So much so that they are the first to offer zero cost commissions in the US. All right, and with that, they are able to offer low prices and higher value to customers. So it's like a flywheel effect. And a testament of their track record, is that the assets held at the company have grown from 1 trillion in 2005 to 7 trillion in 2022. So $7 trillion. That is like an amount that we cannot imagine, right? Okay. And so based on their latest, the financial report, their net interest income is actually contributing 50% to the total revenue. So if you think about it, the rate hikes will have a direct boost to their revenue. And this is also taken from their presentation slides. All right. So despite they say that the rate hikes might be easing down. Okay. So if you look at it, right, the rate hikes go up 4.75, and they predict that it will come down to 4%. But their net interest income currently stands at 1.97%. So they anticipate it will expand beyond 3%, despite all the easing going forward. So if you think about it, 2% to 3% is 1% jump. And if you have 7 trillion, 1%, that's very significant. The second stock I want to talk about is Airbnb. So Airbnb belong to cyclical, I would say, because we talk about traveling, right? And if you were to visit the website, you can see that Airbnb don't just offer hotel, kayak Travago, Pagoda, and all that. So they offer different kinds of stays, right? Ranging from like you have this kind of like what, oh my god, right? This is oh my god. To what Hankoks lah in Korea, Rokkans in Japan, boats, even castles. So you can see that they have a very, very unique niche that other hotel players cannot infringe on. And the other thing I like about Airbnb is their focus on experiences. Experiences. So previously, during the pandemic, Airbnb is stuck there. Then they think that there's nothing they can do. No, sorry. A lot of accommodation players, they think that there's nothing they can do. They just wait out the process. But Airbnb is different because they are a platform. They can come up with new things. So they came out with these experiences, and there are a lot of people already using them. Like this plan the new perfect New York vacation, 157 reviews already, 5-star review. Yeah, so this is something that is another, they kind of help them to build the competitive edge. And okay, let's focus on the investment merits of Airbnb. So post COVID, right, their free cash flow margin trailing 12 months actually stands at 40%. So for every $1 they earn, okay, they make 40 cents of free cash flow. That's a lot if you think about it. So 1 billion is 400 million free cash flow. All right. And in the past, they have a lot of debt, okay, but they have been trying to decrease the debt because in the past it's COVID, so it's understandable. But they have been trying to keep it manageable right now. And if you were to think about it, people still want to go on vacation, all right, but they prefer a cheaper option compared to hotels. Okay, I think an example is my neighbor. All right, my neighbor actually went to, I think, can't remember, Korea or what. So they actually stay Airbnb also. So they didn't go for hotel stay at Agoda or Booking.com, right? Because it's cheaper. And nowadays, if you think about it, the younger generations, right, are going more towards Airbnb. And if the younger generation is at Airbnb, slowly, throughout the years, they'll be sticking to that. And there will be the what you call it, the switching economic mode. Yeah. Okay. And a lot of people, right, in face of a potential recession, they decided to, maybe I rent out my house lah. I offer people scans or rent out things. So it's not legal in Singapore, but there are a lot of countries out there, people are willing to do hosting, to earn extra income during this recessionary period. So with that, yeah, The stock number 2 is Airbnb. All right. Oh, sorry. So one more slide. And maybe I just want to share also about the recent China post-COVID, right, outbound traveling. So they say that the crown jewel has always been the China outbound. China outbound means China people traveling out from China. Okay, and they say that the take rate was higher because the inventory is more unique. Less competition, the average daily rate is a lot higher. So they have an office in China, but they are not meant for people going to China. All right. When people go to China, maybe you want safety, you want to stay at hotel. But it's more for those rich Chinese. They want to travel out, maybe to Singapore, to Australia, that kind of region, and then they look for Airbnb for unique experiences. All right. Okay, the third stop. Before that, let me drink a sip of water. Okay, the third stop I have is Zoom video. All right. So a show of hands, who are still using Zoom at the moment? Again, can type it inside the chat box to let me know. Okay. Meanwhile, I just continue because we are out of time. All right. So personally, for myself, right, I use Zoom during work. Okay. I also use Zoom when I talk to my kids' parent. During the parents teacher conference, I also use Zoom to liaise with the teachers. So if you think about it, Zoom is like has become a verb or a noun for video conferencing, same like Google. You don't know this, go and Google lah. So it has become such a strong brand recall. All right. And what's interesting is that their share price has plunged 86% since the peak at October 2020. And right now, if I'm not wrong, their PE ratio is around 15 times only. Okay. But other than that, a lot of people is saying that Zoom video is going to face fierce competition from Microsoft Teams and Cisco WebEx. So what is it? The real case, right? Let's look at their numbers. Taking their latest financial results, they still have a lot of cash flow. 25% of the market cap in cash, all right, and generating ample free cash flow. So if you think about it, wow, my whole market cap, the stock price times number of shares, 25% is in cash. That's so much. They can easily just buy over anything, right? And they are focusing on this Zoom One. So Zoom One is a suite of the different Zoom products. Okay, is what they are focusing on right now, and it is able to boost their total addressable market, okay, TAM, from 62 billion to 86 billion. So if you think about it, they are fighting against those existing companies like Five9, those call center, whereby Zoom can reach out to the company and say, I will do everything for you. You connect your Zoom, video conferencing, your phone call, everything, mail, combined together as one whole package. Okay, and they are largely focused on the growth in the enterprise segment. So they know that us consumers, we won't pay for Zoom. We can just use the 40-minute time limit. But for enterprise, if you think about it, every month is just maybe $10 over, at most is $20 per person. They wouldn't really scream on that kind of savings, as long as it helps to, maybe also reinforce the work from home. Maybe 2 days you're working from home, you can use Zoom to liaise and things like that. Okay, so this enterprise segment will allow Zoom to do cross plus upselling. Okay, so with that, okay, I've shared the 3 US stocks. All right, I just want to wrap up quickly. Conclusion, there will be a slow US economy in the future, maybe 1 to 2 years time, due to the high interest rates, as well as how everything is still very uncertain. Sectors such as financials, okay, and consumer cyclicals likely to benefit from what we see on the image over there. Okay, and we have covered 3 stocks: Schwab, okay, Airbnb, as well as Zoom video communications. Okay, so if you want more stock ideas like that, okay, do remember to subscribe to my YouTube channel at bit.ly/investkaki. Also share the link in the chat lah. Okay. Okay, so these are some of the videos I've done in the past. Okay, thank you very much.